Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Before we dive into the detailed process of due diligence, it's important to recognize any major deal breakers early on. Identifying these issues up front can save time and resources and help focus our efforts on opportunities that are truly viable. By carefully screening potential deals from the start, we can avoid complications and make more informed decisions as we move forward. Every acquisition starts with enthusiasm and hope. You think you found the right opportunity. But the reality is that many deals fail not during the formal due diligence process, but much earlier because buyers miss key warning signs from the start. By the time you bring in consultants, lawyers, and accountants to dig into the details, you may have already spent significant time, attention, and money on a deal that was never really viable. This underlines the importance of identifying potential red flags up front before investing heavily in the process. The best way to protect yourself in any acquisition is not just to dig deeper with due diligence, but to recognize deal breakers before you even get to that stage. By identifying red flags early on, you safeguard your reputation, your money, and your time. This approach helps you avoid costly mistakes and focus on the right opportunities from the start. In this video, we'll cover how to do this in a practical way, showing you a clear process to spot potential deal stoppers, sharing real examples, and weighing the pros and cons. By the end, you'll have a solid framework to apply in your own acquisitions. Catching deal breakers early offers significant strategic and financial advantages. Due diligence can be costly and complex, so identifying issues right away helps avoid unnecessary expenses like advisory and legal fees, as well as time spent on management and integration planning that might not lead anywhere. Beyond the financial savings, spotting risks early also protects your brand and reputation. Walking away from a deal late in the process can harm relationships and credibility, and it can also create confusion for stakeholders and send negative signals to the market. Addressing problems up front keeps all parties clear and preserves your company's standing. This early awareness is a key part of working smarter, not just harder, in acquisitions. Identifying risks early in a deal gives you real advantages in negotiations because you can ask for a lower price, adjust the deal terms to better protect your interests, or require guarantees from the seller to cover potential issues. It also helps you avoid integration problems later on. Many acquisitions fail not because the business is bad, but because the company cultures or systems don't blend well. Catching mismatches early can prevent these costly mistakes. Lastly, by filtering out weak deals right from the start, your team can focus on opportunities that offer better synergy, a stronger return on investment, closer alignment with your goals, and lower costs when it comes time to integrate the two businesses. This means your deals will be higher quality overall and more likely to succeed. The most important question to ask before diving into any due diligence is whether the business truly fits with your overall strategic goals. If there's no clear synergy with what you already do, it's a major red flag. This includes situations where you can't cross-sell or integrate clients, or if the acquisition would pull you away from your core brand focus. Sometimes a business might offer a solution to a problem that isn't actually a priority for you, or it could divert leadership's attention from more valuable opportunities. When that strategic fit is weak, the deal shouldn't move forward, no matter how promising the financials look. Staying aligned with your strategy keeps you focused on what matters most and helps avoid distractions that lead to poor outcomes. Sellers often reveal more than they realize through their behavior and how they manage information. Pay close attention if the owner is vague, slow to respond, or evasive. This usually points to bigger problems hidden beneath the surface. Major warning sign is when the valuation is driven more by emotion or personal attachment than by actual financial data, which can derail a deal quickly. Disorganized or incomplete documentation is also a red flag. If basic information isn't ready or easy to access up front, the deeper due diligence process will be far more difficult and painful. Finally, be cautious if the seller is pushing for rushed timelines or applying pressure to close quickly, as this often indicates they're trying to hide operational or financial issues. Watching for these owner-driven red flags early helps you avoid wasting time and resources on deals that won't stand up to detailed scrutiny. Culture clashes are more likely to end a deal than financial problems. Some early warning signs include an owner who runs things autocratically and won't accept advice from others, key employees who remain loyal only to the founder rather than the business itself, and resistance to change or modern approaches. A dysfunctional decision-making environment or leadership teams that are weak or toxic also raise big red flags. If the cultures of the two companies can't blend or work together, the deal probably won't succeed, no matter how good the numbers look. So it's critical to assess cultural and leadership compatibility up front to avoid costly setbacks later on. Before you dive into the financial details, it's important to get a broad picture of the customer base. This gives you early insight into potential red flags that could undermine the deal's value. One major risk is if the business depends too heavily on one or two customers, which makes it vulnerable if those relationships sour. Look out for signs that customer churn is being masked by new sales, which can give a false impression of growth. A high percentage of customers relying on discounts might indicate weak pricing power or a fragile revenue stream. Additionally, search for any complaints or reputation issues online that could signal underlying problems. It's also critical to understand whether the business can clearly identify customer profitability. Factors reveal a fragile customer base. It's a strong warning that the deal itself could be unstable. So you want to spot these deal breakers before investing time and money in detailed due diligence. It's important to identify operational weaknesses that could be too costly to fix after the deal is done. Some issues, like outdated technology or supply chains that can't scale, might look manageable at first, but could require significant investment later. If a business depends heavily on the current owner for daily operations, that's a serious red flag because the transition could be risky or disruptive. Poor safety practices and weak compliance or regulatory processes can expose you to legal troubles and fines. Also, a lack of documented processes means there's little structure or consistency, making it harder to maintain quality and control. These kinds of problems can make a business appear profitable on paper, but in reality, they turn it into a value trap that drains resources instead of driving growth. Spotting these deal killers early helps avoid costly surprises down the road. Even before you dive into formal due diligence, it's important to watch for financial red flags that may indicate trouble. Pay attention to high-level financial summaries that don't seem consistent over time, or have adjusted numbers where key expenses are conveniently removed. If you see sudden spikes in revenue without a clear explanation, that's a warning sign, as is a decline in profit margins while staff costs are rising. High levels of debt or liabilities that aren't obvious can also be a serious issue. Additionally, if the company lacks audited financial statements, or if their reporting is inconsistent, proceed with caution. In short, if the numbers look either too perfect or too messy to trust, these are signs that should raise a red flag before you even start detailed examination. When reviewing the legal and regulatory environment at a high level, you don't need to do a full legal review right away to identify major issues. Key deal breakers are easy to spot if you know what to look for, such as pending lawsuits that could threaten the business or significant regulatory changes set to take effect soon, which might disrupt operations or increase costs. It's also important to check if licenses are tied specifically to the current owner or if there are contracts that cannot be transferred, as these can limit the business's future viability under new ownership. Watch out for high exposure to compliance fines and any environmental liabilities, since these risks can be significant enough to make a deal unworkable, even if the financials look promising. Focusing on these legal and regulatory red flags early can help you avoid investing time and resources into deals that have hidden obstacles you won't be able to overcome later. Back in 2010, Google was looking to acquire Groupon for $6 billion, but during the early talks, several key issues stood out. They saw that Groupon was heavily dependent on constantly gaining new customers, which is risky because it's hard to sustain that growth. They also noticed that Groupon was using heavy promotional incentives that didn't seem sustainable long term. Furthermore, the business model itself wasn't very defensible, meaning it could be easily challenged or disrupted by competitors. These warning signs came up before Google even dug into the formal financials or legal details. Recognizing these deal breakers early helped Google step back from the acquisition, which in hindsight was a smart move since the deal faced many struggles after that. This example shows the importance of spotting red flags early to avoid costly mistakes. Uber considered acquiring Lyft in 2014, but noticed several early warning signs that made the deal unfeasible. They saw a significant difference in valuation expectations, which immediately raised a red flag. Beyond the numbers, the leadership styles of the two companies didn't align well, and their company cultures conflicted, which could have caused integration challenges. Additionally, regulatory risks for Lyft were greater than Uber initially anticipated, posing potential legal complications down the road. By recognizing these issues early and stepping away from the deal before entering formal due diligence, Uber avoided years of costly disputes and challenges that could have arisen from pushing forward with the acquisition. Procter & Gamble often uses early pre-diligence screening to evaluate potential beauty brand acquisitions and frequently decides to walk away from deals that don't align well with their portfolio. They look for key factors like whether the brand fits naturally with their current offerings, whether there are synergies with their existing supply chains, and the strength of the brand's long-term equity potential. If any of these don't meet their standards, they choose not to proceed. This approach helps P&G maintain the strength and consistency of their overall portfolio by avoiding costly mismatches early in the process. When Walmart considered entering the Indian retail market, they identified several early warning signs that ultimately led them to withdraw from the deal. They recognized the regulatory landscape was unclear, which posed significant risks to their ability to operate smoothly. Additionally, complicated ownership structures created challenges in maintaining control, and licensing rules added further complexity to the situation. By identifying these factors early on, Walmart avoided committing to a deal that would have involved too much risk and too little control, showing how spotting deal breakers in advance can save a company from costly mistakes. Spotting deal breakers early offers several key advantages. First, it saves significant costs by avoiding unnecessary spending on thorough legal, financial, and operational due diligence when potential issues are already clear. It also protects leadership capacity by preventing teams from spending months chasing deals that are unlikely to succeed. This early identification sharpens deal discipline by focusing efforts only on the most promising opportunities, improving overall quality. Additionally, recognizing risks upfront strengthens negotiating leverage, enabling more favorable terms based on identified concerns. Finally, it helps preserve a company's brand reputation by steering clear of deals that could result in public failures or market embarrassment, maintaining stakeholder confidence and trust. There are some important risks to keep in mind when spotting deal breakers early. First, there's the chance of false negatives, meaning you could walk away from a deal that might have been addressable with more effort. Early assessments also depend on limited information, so you might miss important details. Internal bias is another concern. A cautious team might flag issues that aren't real problems. Additionally, sellers might feel uncomfortable or offended if too many probing questions are asked too soon, which could hurt the relationship. Finally, being too strict or filtering too aggressively can slow down the process and make organizations overly risk-averse, potentially losing out on good opportunities. Balancing these risks is key to making smart decisions without shutting down potentially valuable deals. The companies that succeed in acquisitions are not just those that perform the best due diligence, but those that avoid wasting time on deals that aren't right from the start. Recognizing deal breakers early helps protect your capital, strengthens your brand, improves the quality of your deal pipeline, lets you negotiate with clarity, and makes integration smoother down the line. The most valuable deals are the ones that align strategically, culturally, operationally, and financially well before any formal paperwork begins. In mergers and acquisitions, the quickest path to winning more deals is actually knowing when to walk away from bad ones. Doing so earlier, with smarter judgment and clear discipline, saves resources and positions you for better opportunities. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, Thanks for watching.